This unrest that we see, I know it doesn't affect your investment strategy. I know you're going to tell us that, but it colors the international tone. How does the unrest of America change international investment forward?
Well, it depends whether this becomes a permanent part of the fabric of our society, this unrest and this divisiveness. I think if it's just a passing storm, then it won't have any impact. If this divisiveness continues to elevate and persist, perhaps it will put a tiny little risk premium, all else equal, on U.S. equities. But I do believe our country will get over this. This is something that I think the wrong people are taking advantage of what was a bad situation, and it brought out the worst in certain people, a certain small element. And I think we're going to get over this. We're a good country. The people here are basically inherently good people, and we'll get control of this, and this storm will pass.
We talked to the technology capitalism minister, Mrs. Vestager, of Brussels earlier this morning, and she is, many Americans would suggest, anti-tech. David, from where you stand in investment, American technology reigns supreme. Is it still a value?
I think in some places you could find reasonable prices in American tech, and specifically in Alphabet. In our global portfolios, we still have a large position in Alphabet because we believe if you mark-to-market cash and their assets and give them credit for some of the things they've been doing in investing, that it's still very much a value. It trades at or below the market multiple when you make those necessary valuation adjustments, and it really should trade well above the market multiple.
David, there's an argument about value coming back finally over growth, which has benefited most over the past few years. And this is something that you adhere to and have underperformed as a result of it. In your recent letter to the shareholders, you were apologetic about it. Why do you believe that's set to change?
Because I believe that businesses and stocks really are financial assets, and that the price of these financial assets is an important aspect what makes them attractive. If you could get certain businesses at a fraction of what they're worth being determined by their free cash flow streams. Again, this is the predication that we believe a company is valuable based on what it's able to generate in terms of free cash flow. And if you look at the prices some of these industrial businesses in particular are selling at, that price ultimately will matter. Well, price matters when you buy anything. Now, for a long while, almost the better part of a decade, price has taken a back seat. But when the dispersion between two classes of assets, we'll call them growth assets for lack of a better word, and value assets reaches such a large level, you're bound to see a rebalancing, especially since when people start to get interested in value assets again, the door to get into these assets is very, very small because they've been so heavily sold. They're trading at very, very low market cap. So my argument is that I don't know exactly when this will happen, but when it does happen, you will see such a snapback because there's so little involvement in these assets today. And to me, this is one of the big opportunities in investing. We're all saying, well, the U.S. market is starting to look pricey, et cetera, et cetera. But then again, you could look at segments of the stock market, and especially if you were to look at my area, international value. I mean, this is probably the worst 4 or 5 months I've had in 34 years. And it's the companies aren't just falling apart and going bankrupt. A lot of these businesses are actually going to come out of this just fine and doing very well, and yet they're still down 30, 40, or 50% year to date. And to us, this really represents opportunity. If you could get quality business franchises selling at low single-digit price-to-cash flow multiples, businesses with good balance sheets and good cash flow streams, think of a Daimler or BMW in Germany, or some of the companies in the European financial sector like a BNP Paribas, or industrial businesses like a Glencore. If you could get these businesses this cheap, this is the time, in our view, to be buying them.
David, we got a taste of that last week in certain segments of this market, specifically the financials and specifically in Europe too. But some of that was largely a top-down story. I hope that European politicians got their act together and moved forward with fiscal stimulus and some form of debt mutualization as well. David, I guess my question for you, so someone who focuses much more on bottom-up, whether those trades in Europe that we got a flavor of performing last week, whether they depend on Europe getting its act together at a European level?
I don't know if Europe will ever get its act together, to be honest, because it's just almost impossible for them to do so. You have so many different agendas within the EU. It's hard to get any kind of a consensus. What I think will propel these and awaken these valuations is just through the economic recovery as people get back to work and as economies reopen. And I think this is the real story. Europe came into this a bit earlier. Remember Italy and Spain? Generally speaking, Europe came into this COVID-19 crisis a little earlier and shut down pretty hard. And they're kind of starting to open in many ways earlier. I mean, you see Italy's opening today and almost completely opening. And the German kids went back to school, I think, in April. And so you're beginning to see normalization that will be the light at the end of this dark economic tunnel. And that, to me, is what will awaken some of these value stories as it becomes evident that these companies made it through the storm. Now, the icing on the cake will be if the European Union could ever get their act together, and if, for instance, the Europeans and the British could ever decide on a trade agreement. This will be icing on the cake. Both of these have some potential, but I think that these things are not needed for this recovery to really take off. What's needed for the stock market recovery in Europe to take off is for the economies to reopen and the light at the end of the economic tunnel, and I think that will be enough to shine some light on these values that I've been talking about.
David, just real quick here, I'm wondering how much your outlook for Europe depends on its relationship with China remaining at least where it is now and not deteriorating further amid a backdrop of rising U.S.-China tensions and sort of pressure that they take some sort of stance here.
Yeah, this is an important question because the Europeans as well as the Americans, Europe is a big exporting nation. Germany, Italy, France, they're big exporting nations, and one of their big exporting clients is China, as well as the U.S. and as well as the U.K. And so these economic relationships, the stability of these economic relationships are going to be important, as these economies recover. So I do think that is an important factor to watch. The U.S. actually, it's a little bit less so. The U.S. is actually a little less dependent on China for its exports. Certain sectors are very dependent. If you look at like Boeing as an example, and the egg sector. But for the most part, I think the exports that are most at risk for a destabilized China, the Europeans, this is something you have to watch.